Hey guys, welcome. I think we're just going to allow a bit more time for people to connect. So we'll give it a minute or two and then we can kick off right into it. But yeah, feel free to say hello in chat, and yeah, looking forward to going through this with you guys. Yeah, I still want to give it just a few more minutes, guys, just to allow some connections to happen. But yeah, keen to hear a bit more about you guys. Do you want to maybe just introduce yourselves in chat? Maybe just like who you are and a bit about you. It would be great to kind of meet some of you guys. So feel free just to drop just a short little intro to who you are in chat. Kifari, is that a high five or are you putting your hand up? Awesome, Adisha. Glad to have you here. Yep, Dima, I see that. Good to have you here, man. All right, awesome. I think I'm going to kick it off. Semsudin, how's it? Glad to have you here. Thanks, Stillman. Keen as well to have you on. It's going to be pretty awesome. All right, brilliant. I think I'm going to kick it off. We kind of start with the introductions and also then go through some of the topics that we'll be going through before we sort of jump into the heavy stuff and start going through a lot of the actual detail in terms of what margin trading is and how to kind of effectively use margin trading in the work that you're currently doing. So I think without further ado, let me hop across to my presentation and get this going. So really what we're going to be sort of covering in this class today is obviously giving you guys a good sort of introduction and welcome to us and a bit more about Liberty Finance, who's really behind this class, and who I'm a co-founder at, and a number of the team members are also here. We're then going to delve sort of into what margin is, just so you can sort of understand the principle behind it. I think a lot of people don't understand the principle of margin. They hear the word margin or leverage and they think liquidations and they think people getting wrecked. And I think it's quite important to sort of share sort of what it really entails. And I think if you understand it from the way that I like to sort of see it, it makes a lot more sense in terms of why it becomes useful in your trading. I'm then going to go through risk management, which is a fundamental tool that a lot of people don't quite understand. And it's a critical piece that is required when trading with margin, and in fact, when trading in general. And then we will sort of look at how to trade with margin specifically. We'll look at a few charts, and we'll sort of outline how that can basically work, and kind of sort of figure that out, and take you guys through that process. And then I'll sort of end off with a couple of trading tips, and some things to sort of learn more about. I believe that this space and learning to trade is not just about people telling you what you should be doing, but it's also about figuring it out for yourself and going out there and learning more and finding out and really trying to discover as much as possible. I'll then just really introduce a really cool feature we're building over at LibFi, and then finally we will close off with answering any of your questions that you might have. So as we're going through the class and as I'm sort of explaining concepts and going through some of the terms, if anything's unclear to you, feel free to drop a question in the chat, and we will definitely go back and look at a lot of those questions. If it's something that comes up while we're on a concept, or if I'm looking for a response, we can also go through it then. And then really from there, at that specific point, we would then do our giveaway. So one of you guys on this class tonight or today or this afternoon is going to walk away with that prize. But also everybody is eligible for an airdrop, for attending this class. So I'm really excited to share those details with you. So stick around, and looking forward to jumping into this class with you guys. So really from an introductions perspective, I'm sure by now you've gathered my name is Zen. And really would just like to sort of give you a bit of background, to who I am and sort of how I got here, and arriving at this space. I've been in the ed tech space or industries, I suppose, for more than 20 years. And education really is a big sort of passion of mine. And specifically, one of my businesses focuses on developing technology that drives education through learning platforms and gamification. And it's always been something that's really close to me. And really, getting the opportunity to start something like LibFi has allowed me to take another passion of mine, which is trading, and bring a lot of this education piece that I really love so much together with trading, and really focus on what we're doing from a platform perspective to ensure that it's not only ticks all the boxes when it comes to trading, but it really covers all the educational pieces as well. Because really, if you look at my story, it was early 2017 when I got exposed to crypto, and I bought some Bitcoin. And really very quickly, what happened was that money that I'd invested, that I purchased Bitcoin with, just started increasing in value. And I'd never really traded before, so this was really the first, let's call it maybe real investment that I had made. And lo and behold, as the months of 2017 rolled by, my investment just kept growing, and it just kept getting bigger and bigger. And I bought a bit more, and I bought a bit more, and it just kept increasing. And by November 2017, I felt like an absolute genius. My portfolio was up. I was convinced that I was a trading guru, and I discovered an untapped skill that was residing deep inside of me. Interesting enough, in December, around the beginning of December, I decided to diversify, and I moved most of my Bitcoin holdings into Ethereum and XRP and a number of other altcoins. And we all know what happened to Bitcoin mid-December, and then what subsequently happened to Ethereum and XRP. So not only did I think I was really good at purchasing crypto, but I also began to think that I was very good at knowing when to sell. So by early 2018, I was on an absolute euphoric high. I thought that, I'd discovered, like I said, a new talent, and I was on my way to becoming a multimillionaire. And then something interesting happened. Everything started to drop. Every project I invested in went down. Every trade I made, I lost. And over the course of the next 3 months, I slowly but surely gave away most of the profits that I had made. And it was actually good that this happened to me, because it allowed me to get off of this understanding of just being lucky or right time or right place, and understand that there must be more to what's involved with trading in this industry. And it really was at that point that I took a concerted decision to really understand trading and understand it fully, because I really wanted to understand how come, at one point it went so well for me, and then another point it didn't go well at all. And that's really where I got into learning more and more about trading. And it led me on a very long and explorative journey through both, technical analysis and fundamental analysis. I went deep into not only trading in crypto, but moved into trading Forex and equities and commodities. I then got really interested in options trading and spent a lot of time trading in options. And then really came full circle, back to crypto, but more focused on long-term investing and building as a means to sort of grow from there. But my journey has really been exciting, and it's taught me a lot. And I'm really excited to sort of be with you guys today to share a lot of that knowledge that I've learned over the years, and a lot of that experience that I've had with you guys. So really the goal for today is specifically on margin trading is I want to provide you guys with an understanding of what it is. And I want you to learn a new focus on risk management and how to apply this all within a technical analysis framework. Now, we're not going to go into too much technical analysis detail. I'm going to share some options for you guys to explore after this course. And potentially down the line, we may do some more deeper courses on technical analysis and fundamental analysis. But I want you to understand the basics and how to apply that to your trading style when it comes to margin. And one of the other learning outcomes really for me is that by the end of this class, you are able to understand what margin trading is, that you're able to execute your risk management strategies, and also being able to sort of make informed decisions about the trades you make going into the future. So I think really with that, it's maybe then to sort of understand what really is margin. So in the sort of technical sort of terms, you can say margin is the collateral in terms of capital or securities that an investor deposits to be able to borrow assets for trading. That sounds like a bit of a mouthful, but that in essence what it is, and that's the, let's say, Investopedia definition of margin. But really, how do we understand margin in real world terms? And maybe to make it clearer, I kind of like to look at it in the sense of, let's look at a traditional business loan. So imagine you're a business owner and you borrow $50,000 to purchase some new machinery that will expand your business. If purchasing that machinery with the loan that you got from the bank leads to an additional profit for your business, and after you pay back the loan and the interest or fees, in essence, you make a gain. And that's really sort of how we can look at margin. Look at it in the sense of you're a business owner, trading is your business, and you're wanting to expand your business into a specific trade that you would like to make. And really what margin is, it's a loan that you will take to give you more opportunity to actually expand in that space. So in margin trading, really we can see sort of a similar endeavor, is that you have a thesis or an idea for a trade, and if you're correct with that idea, you'll be in profit. So what you then do is you borrow funds that you need to make the trade and sort of achieve the highest gains that maybe you wouldn't have achieved or wouldn't have been attainable. I hope that makes sense. But as we know, it's not that simple, right? There's obviously a lot more to it. And I think really, first of all, when it looks at margin, we need to understand the different types of margin. So typically on exchanges, we look at two sorts of types of margin. Those types of margin are what we call isolated margin and cross margin. And isolated margin really is margin that is set aside and is used for one specific trade or one specific use case. Whereas cross margin is margin that is shared between open positions on your account. And if we had to sort of understand these different types of margin in trading terms, I think we would look at it in the point of isolated margin being risking only on a single product or an idea. So as a business, you're saying, I'm going to risk just buying this piece of machinery, and there's a specific risk to that product or that service that I'm utilizing. Whereas cross margin would more than likely be risking your whole business on an idea. And this is maybe one of my first anecdotes to you guys is when trading with margin, stay away from cross margin. It really just doesn't make sense to risk your entire portfolio on a single idea. And the reason why I say that is that when you utilize cross margin, all your positions that you have open are basically exposed into your portfolio. However, with isolated margin and everything we've been talking about going forward, will be really utilizing isolated margin, allows you to mitigate and limit the amount that you want to risk. It's like taking a specific loan as a business owner, not an indefinite loan that you don't know, how much you're actually going to have to pay back depending on what happens in the market. So margin, then understanding that and what it is then used really to create something called leverage. So what specifically is leverage? So leverage, and we've all heard this sort of term, it's really the amount of capital or the amount of money that a broker or an exchange is going to give you based on the margin that you hold. So really, in essence, leverage is the ratio of the trader's funds to the size of the broker's loan. So really what that means is if you look at a leverage of, say, 50 to 1, it basically means that the broker or the exchange will give you 50 times the amount of capital that you hold in your account. But obviously, the interesting part to hold this whole thing with leverage is that the higher the leverage, the higher the risk. And we're going to sort of cover that in a lot more detail. But the other thing to sort of be mindful of is don't fall into something which I call the leverage trap. What it means is if you can 50x your gains, you can also 50x your losses. And we see this all the time. In fact, whenever we see these crazy spikes on BTC, most of the time what's causing these spikes is something called liquidations. And liquidations are when your leverage position or your margin position has been exhausted and the exchange or the broker says they now need to collect your capital to pay back the specific loan that you've taken. And the way that they collect that capital is they sell your position. And when they sell, it creates sell pressure, and that creates more selling, which creates more sell pressure. And then we get these huge drops in the actual market, which really are these liquidity events or liquidation events, rather, that happen on a lot of the exchanges. And really what that tells me and what they should tell you guys is most people don't understand how to trade with leverage, and most people don't understand how to use margin. And they fall into this, what we call the leverage trap. They log onto the exchange, they put $1,000 in, they see that they can purchase for $50,000, and immediately they go and utilize all that margin in the hopes of making overnight success and overnight wealth. But really doing that is sort of the fast track to getting wrecked. And the idea here is that if you're going to employ leverage and you're going to use margin, it's to really then employ risk management in all your specific trades. So I think let me then touch a bit on risk management, just to give you a bit of outline on that. So knowing how risky margin trading can be and how much it amplifies your gains, it can also then amplify your losses. We need to employ risk management. So I think what's quite important when it comes to risk management is we need to understand why we need it in the first place. So why do you need to sort of manage your risk? And I think there's a really great example that I'm going to show you guys as to why risk management becomes so key and becomes so important. So let's look at when you recover from a loss. And really what this means is when you make trades on your portfolio and you have a drawdown. So your trades don't go in the direction that you hoped they would. So you see Pepe Coin 2.3 as a great investment. You think that thing's going to 50x. You put all your portfolio into Pepe Coin 2.3 or whatever the coin is that you're really excited about. And what you will learn is that the more you lose on your trades, the harder it becomes to recover from that loss. And in fact, the more you lose, the more exponential that recovery gain is basically required. And to kind of put it into perspective, losing 10% of your capital on a trade, you would only need to make back 11.11% to break even, to cover your losses. Whereas if you lose 40% of your portfolio, suddenly now you need to make 66.6% on the next trade. And it just gets worse from there. At a 50% loss, it means you need to basically 2x your trade. That basically means if you lost 50% on a BTC position, your next trade in BTC needs to be double for you to even just break even. And this is quite important to see, because a lot of people don't realize this when they're setting their stop losses, or when they're looking at the price of something and they're saying, okay, I'm happy if it can drop down to 5%, or I can take a 10% loss, I can live with that. But when you start to exacerbate that, over a number of trades, before you know it, you've down 50% in your portfolio, which means that the next trade, the pressure is on you to then make 100% on that trade just to break even. And if you drop even further, it just gets worse and worse from there. So I think it's really important to understand why risk management becomes so critical, is that it's really to mitigate this pressure that you would put under yourself to recover from a loss, or to recover from a really big loss that would happen if you're not employing any sort of risk management techniques. So one of the risk management tools that I've used, and I've used it effectively once I learned how to use it, and once I learned about trading specifically with risk management and how to apply these principles, was something that's called the 1% rule. And really what the 1% rule states is that you should never risk more than 1% of your trading capital on a single trade. And really, by sticking to this specific rule, what it means is that you can ensure that no single trade will significantly affect your portfolio. And to sort of explain that further, you would need to be wrong on 10 trades to reach a 10% loss on your overall portfolio. Now, if you're wrong on 10 trades, then I don't think risk management is your challenge. I think your technical analysis, or the decisions that you're making to enter those trades, needs to be relooked at. So really the idea here is, by mitigating your risk to just 1%, you could ensure almost longevity. It's like playing a video game, and instead of having 3 lives, you've got 100 lives. You've got a far greater opportunity to reach success. You've got a far greater opportunity to reach the end of the game, to make it to the final level, whatever your specific goals are. So to give you a sort of example of this, if you have an account of $10,000, you should only be risking $100 on every single trade. You shouldn't be risking more. And in fact, what you will come to learn, the more you get involved in margin trading and the bigger your account size gets, and the more your actual 1% becomes, is that sometimes it actually makes sense to risk 0.5% or 0.25%. But for the purposes of this class, and just for sort of showing you guys this, it really is about using sort of 1% of your portfolio and just giving yourself that opportunity to be wrong a number of times. So now that you sort of understand, okay, well, what is the 1% rule and what amount of capital do I need to risk? What does this all basically mean for me? I mean, how do I now actually use this to sort of start trading? And how do I use this to actually then become profitable? And if you remember earlier, we spoke about, margin in terms of having a business and investing in machinery with a loan from the bank. Applying these rules is very similar. This is the operational sort of principles behind your business. And you almost need to look at trading as a business, or as a job, or as a profession. And you don't necessarily need to be a professional trader to do this. You just need to approach it with that mindset of, all right, so I've got this one rule now. I can risk only this amount on every single trade. Okay, great. What's the next rule that I need to apply? And what's the next sort of thing that I need to focus on? So now you understand what our risk amount is. We then need to work out something called our risk reward ratio. So if we're going to risk $100, we need to figure out, well, how much do we need to make in terms of profit from that $100 that we're risking to make it worth our while? And the next thing we really do then is we then calculate what we call our risk reward ratio, or your RR. And for me, the definition of the risk reward ratio is the potential loss of a trade, or the risk, and the potential profit, or the reward. And you really calculate your RR by dividing the profit by the loss. And this becomes quite important once you start understanding RR at a later stage. So the key part to working out your ratio is to first also understand your win rate. And to understand your win rate, unfortunately, you need to start trading. And if you've been trading for some time and you've been journaling and you've been logging all your trades, or you can go back into your exchange and you can actually go and pull the log, it's really important that you then go and figure out what your win rate is. And what I mean by win rate, I mean your win rate is the number of times it takes you before you are right on a specific trade. And this is the other thing that no one really taught me before. And that was, you don't need to be right all the time. You know, a lot of the times I would get very despondent if my trade didn't work out the way I wanted it to work. And in fact, in those early days when my portfolio just kept diminishing at 5%, 5%, 5%, I was really despondent. But once you start to understand some skills, and once you start to learn how to make, better entries into trades, once you start to learn how to read technical analysis or follow the right news sources, and once you start actually becoming successful, and when I say successful, you're not losing as much, and you are definitely entering trades that are going into profit. Your thesis is that it's going to break out from this price and it's going to reach a certain level, and you're right. That is really what we call a win. So what you need to work out is the number of times you are right. And really that will define what your risk reward ratio is and what it should be. So for example, a risk reward ratio of 1 to 3, meaning that I'll risk $100 in the aim to grow that to $300, would be then on a win rate of about 25%. So if 1 out of 4 times you are right, then that is the sort of risk reward ratio you want to go for. And if you are less right, then it would increase, or more right, it would decrease. But ultimately, it's about finding what that RR is for yourself, and then treating it like a business. Treating it in the point of, if I hit that reward, then I take my profits and I move on to the next trade, or I wait for the next trade to develop and I go into that. And really, it's a principle that you apply. And by consistently sort of applying that, you then consistently grow your account. And even with an RR of, say, 1 to 2, or even 1 to 1.5, for every $100 you invest, or every 1% that you risk, if you're making 1% off of that, what that really means is that over time, your portfolio will grow. And a lot of the times we kind of see what happens out there in the world of, I think it's not, we can't call it crypto Twitter, it's crypto X, where we see people making these crazy gains, and we see a lot of these posts of this DeFi wallet, bought these coins for $1,000 and now it's worth $1 million. And whilst that's all very exciting, those guys in essence have won the lottery for the most part. There's definitely a small few percentage of people that really understand what they're doing, and it's all part of what they're doing. But interestingly enough, if you really had to look into it, a person that invests $1,000 on a meme coin that turns into 10,000 or turns into 100,000, if they're a really good trader, their portfolio is probably worth $100,000. They're probably only risking 1% of their portfolio on that specific trade, if they really understand trading. And they're not just taking a luck and, let's say, gambling on a specific or hopeful outcome. So I think now that you sort of understand what your risk reward rate is, and you understand what the risk amount is of your portfolio, you really now have a clear sort of indication of, how do we put this into practice? So I think typically, if we had to look at it without sort of margin and just with a standard account, what you would do is you would get the sort of current price of the token or the coin that you want to trade or that you want to invest in. You would do some analysis on that project to kind of figure out where you think that price is going to move. So is it going to go up, and how far do you think it's going to go up? Based on that, what you would then do is you would calculate your sell and take profit prices, and then you would execute the trade. So if we had to look at it as an example with using, say, a $10,000 portfolio again, and say we have a coin that costs $50, and we believe it will increase by 5%, based on our technical analysis, based on what we're hearing in some of our Telegram groups, and just looking at the overall movement of price, we're pretty convinced that this will go up by at least 5%. So if our max risk amount is, for example, $100, and our risk to reward ratio we've worked out is, say, 1 to 1.5, then really we should plan our trades where our loss will not be more than $100 and ultimately our gain would be 150 based on this system, based on what we're wanting to basically do. So for the $50 coin, what that means is that you believe that will increase by 5%. So maybe the price will be 52.50. You would basically need to purchase 60 of those coins for $3,000. And when it hits your specific price or hits your target, you could then sell those for $3,150. And that would net you a profit of $150. And you've kind of hit your target according to your risk reward ratio and according to the amount that you should be risking. And it's a good day. It's a day to go out and celebrate. It's a day to go out and say, I did well today. I achieved, and it worked out well for you, which is great. However, if the coin reaches, say, your stop level, which would maybe around $48.33, you would sell it for $2,900 and make a loss of $100, which is not a big deal. It's 1% of your portfolio, and you've got 99 more times to try. In fact, a lot more than that from that specific point onwards. So great. So now that we sort of understand the 1% rule and our risk reward, what about our price targets? What does this all have to do with margin? And maybe the question then to go back and think about it this way, if we look at the business example where you don't have the capital to purchase machinery, so you take a loan from the bank to purchase machinery that generates more profit for your business, you might not have the capital available to take a specific trade that will generate you profit, or the capital that you have might not be enough to generate the profit you need to maintain your risk to reward ratio. So, for example, when does margin then become important? When we looked at that $50 coin, thinking that it's going to go up 5%, we've all seen how trades work. We've all seen the price action of charts, and we'll look at some charts just now. But it doesn't necessarily just go up by 5% in a straight line. There's volatility. So what if it is volatile? Meaning that what if it goes up 2% and goes down 3%, and then moves up 4% and then goes back down 5% and then up 5%? What if you keep getting stopped out before finally it makes the move that you predicted that it would move? And this happens. In fact, this will happen no matter what. But in this scenario, your chances of actually then being profitable and of increasing your win rate and having a good win rate are diminishing because you are kind of limited by the amount of capital that you're actually able to put into this, in terms of just the capital that you have on hand and the structured volatility of price movement. Or how about something different? What if you already have your capital locked up in some other trades that are maybe in profit? Now, you don't want to sell those positions so that you can take out a new position. So now you don't actually have the capital to actually enter in this trade. Or what if you could risk 1% of your portfolio without actually having to put up 100% of the required capital? And that's really where margin trading comes in. It's that you're able to have this ability to still maintain your risk to reward, still maintain your risk strategy, but without necessarily having to commit the entire amount, the entire capital. And what if you could then risk 1% of your capital to kind of achieve a higher risk to reward ratio, which is one of the key things to margin, which a lot of people don't quite understand, is that it's not just about giving you the ability to trade more than your account size, but it gives you the ability to risk still 1% of your portfolio, but achieve a higher risk to reward ratio, achieve higher gains from those specific trades that you make. So really all of the above that I've sort of mentioned is where margin actually comes in. So when we look at trading with sort of margin and leverage, without margin, we are kind of limited to only being able to trade within the time frame and the levels that our portfolio allows. And I think really it's at this point that I'm going to hop into a chart and just go through a bit of a few things on that to sort of explain that. But really, this is where it becomes quite important. And I'm almost going to kind of show you guys sort of how we can almost time travel, if you want to call it that, on the charts using margin, which I get really excited about. So let me see if I can switch up the screen and let's get this sort of logged on and logged across. Okay, fantastic. So I want to now switch screens and switch windows here. hopefully this is actually pulled up. It's a little chart of BTC way back when, not too long ago. But I thought I'd really sort of showcase this to you guys and sort of just give you what we sort of look at, and we can start actually sort of understanding this. So what do I mean by without margin, you are constrained to the time frame that you trade in and to the levels that you define. So to maybe step back, I'm going to do a little bit of technical analysis. And what I've come to learn is that perhaps my way of reading charts might not be the same as yours. It might not be the same as Chris's or Stillman's, or we all have our own unique way of looking at it. But fundamentally, a good trader technical analysis bases the analysis on really two things. One is price and price movement, and the other is volume. Those are the two sort of key, I would say, indicators that are the most important when it comes to technical analysis. What is the price of something, and how's that price moving through time, and how much of that something is being traded as those specific prices. So for my technical analysis, I use a very simple sort of breakdown. I use an RSI with some levels, which sort of gives me an idea, an indication of where price is at and where sentiment is sort of at. I then use two moving averages on this time frame, as well as then I'll use something called a VPR, which tells me the volume profile at certain levels. This really just gives me a lot of information. But you can also then, just by looking at a chart, start to pick up certain levels. So for example, here I've identified this as a specific level that I like, down here at 25,800, based on the volume profile that I'm seeing here, based on where the price is. There's also volume up here, and that could also be potential target levels. And if I zoom out, there could be higher levels up there. But really what I'm seeing is that this is the kind of level on this time frame that I would be looking for. And this kind of looks like it's acted as support over some time. And this has kind of looked like it's acted as resistance. So those are sort of the levels that I'm quite interested in. So if I really wanted to then apply this sort of 1% rule to this specific trade by looking at these levels and looking at where things are at, from a technical perspective, if I wanted to enter in at this specific price of Bitcoin at 26,000, really at this point, I would then, looking at my account size that I had and looking at where my stop loss level is, it would basically dictate, and as we look at a 3% or 3.1% drop. So what does that mean for my portfolio? Well, that kind of means that I can only really use a third of my portfolio roughly to enter this trade, to ensure that I don't lose more than the $100 that I'm allowed to risk, which I can do. I can take this trade and at this specific price here, I can buy $3,000 or $3,333 of BTC. And if the price of BTC drops by 3%, I'll lose $100. And if it increases, for me to hit my RR, say 1.25, I would really need that price, or at least let's even look at an RR of 1.3. I'm quite a successful trader. Maybe every one in four trades I get right based on all the analysis I do leading up to the trade. It would still mean that the price would need to at least break way above the structure for me to hit my RR. And immediately when I'm looking at this, I'm seeing that, well, I'm now tempted to do a few things at this specific point. I'm tempted to just make trades that are maybe not correct, or if I'm not fully focused and I'm following my system, we may never see 9% gain in the short to medium term. I mean, it might do a 6% gain and then come right back down and stop me out. So really looking at this, and really what I mean is I'm limited by my portfolio. I've only got so much capital available, and I'm only able to trade a certain amount because of the capital I have available in my portfolio, which means that if I want to apply the 1% rule and I want to ensure that I give myself enough longevity and enough breadth and scope to trade, then this is my limitation, which then ultimately means that I can still be profitable and I can still follow these rules. It's just going to take me a lot longer, and it's going to be a lot harder to sort of achieve those. We'll get a bit more into this as we sort of progress through it. But I think really maybe to sort of understand this a bit more, and let me see if I can just switch my screen out back to that over there. All right, awesome. So by looking at the chart, and when we can see that, for example, that, when we look at the levels on the chart and when we apply our 1% rule and our risk reward ratio to it, it kind of limits us to what we're able to do. Because in fact, if we were really going to apply that rule fully and follow that rule 100%, like it is a business, we wouldn't even enter that trade, because we'd look at that trade and say, well, the risk reward ratio just doesn't meet the levels and the targets that I can physically see on the chart, according to my thesis and according to my planning. So what do we do? And how do we sort of change this up, and how can we sort of improve upon this? Well, I think really you can basically use your levels and margin together. So how do we kind of do this? So really the first step would be you define your stop loss, which we did. We defined the sort of level of support where we think that if it goes below that level, the whole structure is invalidated and the trade is invalidated. And now we can calculate our targets by applying our risk reward. So remember, how do we calculate our targets? Well, if your risk reward is your potential profit over your potential loss, then a risk reward of, say, 3 would be X divided by 3%, which is the potential loss that we know, which means X is equal to 9%. And that's how I got to the 9% gain that you would need to make to hit an RR of 1 to 3. So basically, this tells me that the target price will be 9% higher. That's exactly what I showed you on the chart. It's how I sort of got to that level of needing the trade to increase by 9%. But interestingly enough, is if we use, say, for example, 3 times margin or 3 times leverage margin, we set our stop loss to just a 1% below the price. And at a 3% price move, we hit our RR. And what's quite interesting about this is now we're saying, well, we're not waiting for the price to go way down 3%. We're also not waiting for that price to go way up to 9%. We're just tightening our approach. And what we're doing with a Titan-based approach is we are now giving ourselves a better opportunity. The price only needs to move up a smaller amount for us to hit the same RR that we wanted to achieve when we first initially looked at the stock, and we first initially looked at our portfolio and what we're able to risk. And then what's even better about that is you can compound that, because with margin, you don't necessarily use your full portfolio and have your full portfolio margin. There could be a component of that or a portion of that. So if we wanted to use the 3x margin, you then would say that a 3% price move gives us our RRR. And if we looked at that structure on the chart, where we saw easily a 6 or 7% move from that sort of breakdown that it was making, from that structure it was forming, looked possible, then we could be quite assured that a 6 or 7% would actually be double our RRR. And in fact, then we're actually exceeding what our risk to reward ratio would be. And that's really a space that you want to be in. And that's where you start to sort of maximize your gains. So really then the question is, well, how do you change your stop loss from 3% to 1%? And I think you can't just move it. How do you do it? So what you actually do is you move down time frames. And that's where I sort of talk around almost becoming a time traveler. So the way I like to look at it is that your risk to reward should be defined ultimately by the time frame in which you trade typically. So if you typically trade and your win rates are typically traded on the 1 hour, then your risk to reward should be based on the 1 hour trades. Or if you trade daily, it should be based on the daily. If you trade weeklies even, it should be based on the weeklies. Your RR should be based on your time frame. You shouldn't base an RR on multi-time frame trades, because you could, for example, be extremely good at trading at a 1 minute chart and think that you've got an amazing win rate, and then suddenly try to trade weeklies and blow your account. So stick to the time frame that you're most comfortable in. Stick to the time frame that you trade the most in, and that becomes where you develop your RR from. But your analysis should be one time frame higher or lower. Maybe I got that wrong. Higher, in my mind, higher is smaller, but it should be, sorry, one time frame lower. So what I mean by that is, if you trade on a 1 hour, you need to learn to do your analysis on the 10-minute. And that is really where you can then use margin to kind of achieve bigger gains on a higher time frame. And I'm going to actually just show you guys that more practically when we jump into the actual chart itself. So let's hop back to our little BTC chart and we'll have a look at that. And so what I basically mean by lower time frames, sorry, not higher time frames, that's a type on the presentation, is that what I'm going to do is I'm going to switch from, say, the 1 hour, and I'm going to drop down to the 10-minute. And if you want to understand sort of time frames, they kind of work in 60s. You know, they're kind of the way that the whole time system has been built. That's at least the approach I take. I have seen other time frame methodologies work, but once again, it's what works best for you. It's what works in terms of being the most comfortable for you and what generates you the best sort of win rates. And unfortunately, only over time do you sort of get that knowledge. So when I drop down to this lower time frame of 10 minutes and I apply the same analytic sort of techniques on this, I can start to look at things a little bit differently. I can see that we're sort of painting a bit of a flag there. I like the consolidation that's happening. I know in the back of my mind that on the higher time frame, this whole structure is looking bullish and things are looking good. So what I'm then able to do is I can then decide to use this structure to base my trade off of. And when I'm using this specific structure, we'll just zoom into the structure even more so we can actually see it where it's at. Looking at this structure that we're seeing over here, there we go, that's better. It's not so zoomed out. We can see a nice sort of level of support appearing here. And this level here now, interestingly enough, that we're looking at, puts me at quite an interesting price target. And if we actually kind of look at that from the current price, where is that? We can draw a little price line, which would be this guy over here. And that's just at around 1%. So as you can see, thank you. As you can see now, all of a sudden, we're now able to risk 1% on this specific trade at this specific timeline. And by juicing this with margin or by using margin to increase the capital exposure, now when this trade breaks out and now when this trade actually does what we wanted to do, we then attempt, or typically then would get the effect of, in essence, being on this time frame and getting an RR, which would have required us to wait for a lot more drawdown to get a lot more sort of draw up. And I think things quite interestingly happened at this specific point. You know, we can sort of play it out. There's some craziness that happened, and it did eventually sort of make the move that we wanted it to basically make from here. And I think really that the point I'm trying to make is when trading with margin, your analysis must be on the time frame that you're comfortable with. But when you're looking at sizing, you then need to then use levels from the higher time frame to sort of achieve that. So I hope that kind of makes sense. But really the idea here is that you want to ensure that you are able to almost get the best entry for the time frame above. And by doing that, you can then use margin to increase the exposure of that specific entry. So you're still risking 1% of your portfolio, but your exposure to that is a lot higher. Your exposure to that means that your gains get amplified, but you're still only risking the amount that your portfolio is kind of set, or the rules that you've set for yourself are able to risk. Awesome. So let me continue on and just chat through a few other points that I just really want to cover with you guys. So I think really if we step back and we look at what we've learned, we've learned that by using margin, we can trade higher time frames with less capital. We've also learned that using less capital means we have more opportunities to trade other assets. It also means that we're not limited to our time frame and can benefit from timeframes above. And really the goal is to get comfortable in your time frame for entries and use that to trade higher time frames with margin. So really, if you're comfortable on the 1 hour, you should really be aiming to then trade on the 6 hour or even the daily. So if you get really good and you hone your skills and you're very comfortable at that point, margin is going to allow you to trade at a higher time frame. It's going to allow you to increase your potential gains over the long term. And obviously, if you can get better at entries at a lower time frame, that's really the goal of what you want to try and sort of achieve and get to. So I think really what I wanted to chat about now is one of the other sides of margin trading and leverage trading, which a lot of people don't really get into, but we see it a lot, we hear it a lot, we see a lot of posts about it on Twitter. We've probably experienced it. I know I have. When I first discovered leverage, and I was completely misconstrued about what it meant. I was one of those people that I saw it on BitMEX and I was like, oh wow, I only have to risk, I only have to put in $1,000 to make a $10,000 or $100,000 trade. What could go wrong? And a lot went wrong, and I learned a lot of hard lessons in those early days on BitMEX. But I think I want you to understand is that when you 3x leverage a trade, you're also 3xing your emotions. I think it's such an important thing to understand. And the problem is that emotions and logic cannot exist at the same time, at the same place. It's just physically impossible for someone to be logical and emotional at exactly the same time, at exactly the same place. And when you trade with emotions, this means that all logic goes out the window. And like I said, we've all been there. So what goes out the window? Your logic of you had a plan and that you're meant to stick to it, and it's now sort of going against you, or holding on to a losing trade because you just believe and have this feeling that it will turn around and it will get better, or making really crazy decisions, or exiting too early, or whatever it is. Once you get emotional, logic goes out the window and you make all sorts of crazy decisions. And take trading aside for a second and think about a time in your life when you've made a decision in an emotional state, when you were angry, when you were maybe excited, and think about how that decision turned out. I can almost guarantee that most of the time the end result wasn't great. Emotions, unfortunately, don't lead to good decisions, because they stop logic from sort of being in place at the same time. So when you're using leverage, your emotions are going to be supercharged too. And that's really where lies the risk. So what you really need to do then is learn to, I suppose, become emotionless. And for me, that's a bit hard. We're not all psychopaths. So how do you become emotionless? We are humans, we have feelings. And in fact, most of what we see in the markets and most of what we see in price action is driven by people's emotions. It's driven by people's fear or people's greed, people's worry or people's excitement and elation. And we could probably do a whole series on emotions and emotion trading. But how do you become emotionless? And I think really for me, the key way to manage my emotions and what I've seen work really well is to start with a plan and then monitor the emotions. So we've all heard this sort of age-old saying, failing to plan is planning to fail. And you know what? It's actually true. And a lot of times these things and these phrases and these catchy things that we hear that we think, oh, that's just everyone says that, or that's something that my parents used to say. They ring a lot of truth. And the reason why they said so much and they said over and over and over again is because they are actually true. And this is one of the fundamental ones. So when you plan to trade, when you create your plan, like I had my plan there, where I said that this would be my stop loss level, this is where I want to exit, this is really where I'm going to enter. That is the plan, and I should stick to that plan no matter what. And then when I execute my plan, and my plan starts to go according to plan, I need to monitor my emotions. And I need to monitor my emotions, both positive and negative. And when I feel that my emotions are too high, I should exit that specific trade, no matter what the current outcome is. Because once again, you need to note that emotions and logic can't exist at the same time, at the same place. And just applying this simple methodology to what you're doing will definitely increase your ability to improve as a trader and improve your win rate and improve your success rate. And it is hard, but at the same time, it's also quite easy, because once you make the decision to say, that's my plan, I'm sticking to it no matter what, it's actually quite a nice feeling, both when your plan goes according to plan, but also when your plan doesn't go according to plan. When you do get stopped out, because it means that your plan was executed. It means that what you said was going to happen and what you planned for happened. And the goal then is to go back and to sort of analyze it. And one of the things that I highly recommend is that you track a journal, and you keep track of every single trade that you're making. And you reflect on that weekly. And when you reflect on your journal, what I typically put in my journal is a column for my emotional state, when the trade was made, when the trade was exited. It's always good to sort of understand where your emotions were at those specific points. The other sort of tip that I want to share with you, and I'll share the list in a second, is to plan your week ahead, or plan your day ahead. One of the worst things that you can do when it comes to trading, in my opinion, is coming into the market blind. Coming into the market without even knowing what's in the market, what's potential, what you're looking for. And the reason why I say this is the most dangerous form, at least for me, in my opinion, is that you can easily be sparked by certain events that are happening. So if you're not paying attention and you come onto the market, and we see what happened a couple of days ago with BTC and the grayscale news, and you see the sun pump, immediately you're going to feel FOMO. Immediately you're going to feel that you need to get involved in that trade. And unfortunately, I said the word feel twice, which means you're coming in with an emotion. You don't have a plan in place. You're going to rush into it, and more than likely you're going to get wrecked, or it's not going to go according to the best possible way that it can go. So plan ahead. Don't be reactive to the market. And I think the best way to do that is to spend time the week before, the weekend before, looking at the markets, looking at things, and making that part of your plan, saying that these are what I'm looking at. And if these stocks reach these prices, that's when I get interested, and set alerts. And once again, there's a whole bunch of information we can share. There's a whole other series, I suppose, that could be done on that. I think one of the last sort of tips I want to give you guys is join a vibrant trading community. Link up and hook up with other traders. Link and hook up with people that are like-minded, people that are also interested in honing their trading skill, are also interested in becoming better traders, not just about making money or making profits. People that are interested in the nuances of technical analysis. And in fact, there's actually a really great group. They're called the Trading Dojo. Stillman, one of our advisors, is also on the call. He's one of the founders of that group. And I'd highly recommend just going and checking it out, and going and join their channels and just meet the guys and really see what they have to offer. Joining that sort of community really helps. And really it is about finding that community, or finding that connection with people that are like-minded and want to achieve the same goals and same results that you do. So I think really at this point, I've sort of covered and imparted, I hope, some knowledge and giving you some insights, and hopefully taught you some things that you didn't know, or given you ideas for some things that you did, maybe better ways of approaching it and better ways of using it. So I suppose maybe the question is, why Liberty Finance and this masterclass, and why are we doing this? And I think it really is in sort of the gear up to our trade boost function, or our trade boost feature that we're currently developing. Liberty Finance is about building a decentralized exchange and a decentralized platform with centralized exchange features. So without the custodial risk, with the full decentralization behind it, but giving you all the features that you are comfortable with, and you've come to learn, and that you will learn about, and that you've even learned about in this class, but in a decentralized space. And one of these features that we're creating is something called Trade Boost, which is actually a unique way that we've developed that will enable users to trade with margin and leverage using typical AMM pools. And that's really exciting, because it's not using perpetuals, it's not using perps, it's not using synthetics, it's using the actual AMMs. It's trading with margin and leverage like you would in a traditional stock market, on a traditional exchange like Interactive Brokers, where you physically are buying the actual assets. It's not a representation of it. And I think what makes this even more exciting, which sort of lines up with LibFi's ethos, is that these features will be compliant with Islamic finance, and compliant with the Sharia principles, and will make this actual functionality accessible to all. And if you've heard anything about what I've kind of taught over the last 60 minutes, is that margin is a tool that can be used to improve your ability to trade. It's the same as a tool that a businessman can use to improve their business, to invest in new machinery when they don't necessarily have the capital. If you understand that that's what margin is about, and that's what it's able to give you as a trader, it then becomes a valuable tool to any trader to utilize. And it's why it's so important that we offer this to our community, and we offer this tool set or this capability on our platform, so that we could give everyone that sort of opportunity to make use of margin and to have this ability to sort of increase their potential. So I thank you guys for listening to me for the last hour, and it's been really great sharing this knowledge with you. I think what I'm going to do is I'm going to switch across just to go through any questions and comments that you guys might have, and sort of take it from there and see where we're kind of at. So I want to have a quick look here and see where we're at with any questions. Okay, so let's go, and I'm just going to run through these. So video on YouTube, please. Yes, Marine, this is being recorded. We are going to push it to YouTube. So yeah, you'll be able to listen again. No problems, no problems. No worries. Stillman, I know you mentioned another aspect would be mitigating exchange risk. That's also very true, you know, and I think that's also a point maybe that we didn't make. So thanks for raising that, Stillman. It's that you don't necessarily need to put all your capital onto an exchange. You can only put a smaller amount of capital onto that exchange and use margin to still get the same benefit as if your entire portfolio was on there. So in cases of things like FTX and all the other exchanges that we've seen collapse, you know, that can be quite beneficial. Definitely like that. Good point. Good point. Crypto research, 100% on too many indicators. The more indicators you add, the more confusing it becomes. So definitely something to sort of take note of. Fantastic, fantastic. Dude, I'm really loving these comments, guys. Okay, so Gifari, I know you asked a question is if you can use this kind of strategy with risk management from 1% portfolio. I'm new to trading. Let's say I'm trying to trade. Do you think it's enough starting with $100 with $1 per trade, or do I need bigger capital to start trading? That is such a good question. You know, when it comes to risk management, and this really is what you need to sort of look at and what you need to understand. I mean, Gifari, what I would actually recommend is before you trade anything is paper trade. Paper trade until you are super confident with your capability and you're super confident with your technical analysis. Because then at that point, then, you know, you can risk initially to grow your capital base a higher amount, say 5% or 10% on a specific trade. Because at $100, you know, especially after fees and gas and whatever else is going to go into it, you aren't really left with much. And I think that's obviously one of the challenges. So definitely would recommend paper trading. And what paper trading is either opening a demo account on an exchange or using TradingView with the replay functionality, just to hone your skill and really get good at entries and exits and understanding where levels need to be and planning those. And at that point, once you're really comfortable with that, is then to actually use actual capital and take it from there. But at the same time, you know, the beauty of crypto and the beauty of what we're even building from a LibFi perspective is that our exchange is going to basically practically cost next to nothing in terms of gas fees and platform fees. So you'd really only be paying the minimal fee for the actual trade themselves. So you could really start with a small amount and apply those same principles. Most definitely, most definitely. So Adisha has got quite a cool question here. What do you do if you're losing too much on trading and can't control emotions and ego of chasing the loss? So when we were actively, well, when I was really actively trading, so at one point specifically, especially during COVID, you know, where we were all locked down and we had a lot of time in front of the screen, I traded a lot. I traded on very, very, very low time frames or very high time frames. I always get it mixed up. 1 minute charts on Nasdaq futures, and I was very laser focused and I was very involved in it. But I would have days where my emotions would get the better of me, and really there was two things we would say, and one would be you need to sit on your hands, like literally if you need to, like physically sit on your hands so that you stop clicking around the screen and you stop actually doing things. But sometimes the other thing is just to take a loss day and say I'm not going to trade today, and rather do that and walk away and learn to take your mind off of what you're experiencing until you've reached a sense of calm and you're able to come back with a sense of logic before attempting again. But really, when you get to that point, is you shouldn't be at a point where you're chasing losses or where you are running wild with ego and emotion, because at the start you really should have a plan and you should stick to it. And I think that would really be your first step, is start formulating a plan and just stick to that plan. If the plan doesn't work, if the plan's not, by not working, what I mean is not generating you a profit, then do what any good business would do. You would either change the staff or change the strategy or try a different approach. So be open-minded to actually do that and make those specific changes. Dima, how many years does it take to trade to become a professional like you? When I started off, when we first started learning, and I was trained, by some really awesome people in the space. And then I spent time with another group down in Puerto Rico, which ran a fund. There were guys that just had a natural knack for it. So I don't think it's how many years. But what I can tell you is practice makes perfect. And using the replay functionality on TradingView is a great way to practice the skill set of technical analysis and to get good at trading. And I think what they say is to master any profession, you need to have at least 10,000 hours of experience. So if you want to master something, you've got to put in at least 10,000 hours to become a master. So I hope that sort of answers you. And I hope that sort of gives that. Stillman, thanks for dropping that response. Appreciate that. Awesome stuff. Brilliant. Guys, this has really been great. So I think I'm going to pause it here and I'm going to switch on to our giveaway. So what we kind of said with this, and it's such a pity that people didn't show up, but we hope that you guys would spread the word after this and you would really get value out of this, and we hope that the value from this this course gets reached far and wide. And the next one we do, we would have more people engage, but we do honor what we say. So one participant today is going to get 500 in USDT, and everyone that's attended will be eligible for a $100 LibX airdrop when we launch. So what I would like you guys to do to sort of to earn this is, I want you guys just to write a post or a blog or an article. It doesn't need to be elaborate. It doesn't need to be huge. It just needs to put down what you've learned and what you've gained from this. And then just tweet your article out and tag LibFi and use the hashtags, hashtag LibFi, hashtag LibFi Masterclass. And once you've done that, just email your entry through to us. And we're going to allow a couple of days for everyone to sort of email that through. And then we'll do a follow-up call where we will then choose from all the entries the winners. But everyone who does enter will get 100 LibX in airdrop. So if you just enter, you will get 100 LibX. And I suppose this goes for the people that are going to watch this hopefully on YouTube over the next day. But we will randomly select. So it's not going to be a vote. It's not going to be a choice. It's going to be a random selection of who actually gets the $500 prize. And we're going to aim to do that draw or that random selection for the $500 prize on Sunday evening. So you've got a couple of days to kind of put that together. And yeah, looking forward to seeing what you guys can put forward. And once again, guys, it really doesn't have to be elaborate, But if you've taken a lot from this and you want to share this knowledge with the world, please do. But really what we want to do is just to contribute back to the community. So we're looking forward to hearing what you're able to give us. So guys, thank you so much for joining. Thank you for sticking through this. Remember guys, learning should never stop. You should always be getting sort of knowledge out there, finding out various things. Follow our socials, look out for our next masterclass. We're definitely going to do a few more of these in the future. Hit us up on Telegram and Discord if you want any information or guidance or assistance. We had some good questions come through in this class. So keen to sort of to help you. And a lot of us that are involved in LibFi, and a lot of us in the community have a lot of experience. So if you are stuck, just reach out. Definitely join the trading dojo. Go check them out. They'll definitely be able to help you, especially if you're coming from a beginner level, and they're able to guide you and help you a lot with the stuff that you've got there. And then also look out for LibFi's launch. It's coming soon. There's some exciting things happening with the LibFi project. So look out for that. And thank you all for attending. Thank you all for being part of this experience. This is our inaugural masterclass event. And looking forward to getting your hashtags and your responses. Looking forward to giving somebody $500. And wish you all a phenomenal day, a phenomenal evening, or phenomenal night, depending on where you are in the world right now. Thank you, guys.